Today I'm joined by Harry McGregor from TMNZ, and today we're going to be talking about tax pooling and how businesses can use it, and essentially what does it even mean. Now, Harry and I have known one another for a number of years now. So Harry McGregor is a chartered accountant. He's worked in accountancy practices, but now with TMNZ, look, a lot of people might not understand what is TMNZ. Can you tell us, please?
Yeah, so it's a tax pooling intermediary. We were the first one. Our founder, Ian Cooper, is actually a Timaru boy, so there's a few clients that'll be down there. So it's a great idea, born out of Timaru, and we sell excess tax to clients. And the best part is our profits get reinvested into Aotearoa, which is really, really cool.
Awesome. In fact, you have told me this before. What's the number over the last few years? It's a huge number that you've put back into charities into New Zealand.
Yeah, it's in the $30 million range. It's a fair chunk of cash which has been reinvested into some really fantastic charities and doing great stuff around oceans and children of the country.
Wicked. There's one thing actually where we've spoken in the past that small business owners have got the opportunity. Do you want to pay the IRD first, or do you want your bank to earn interest? Or there's this other option that actually you can be giving to charity through paying your tax this way.
Get a cheaper rate and supporting charity at the same time. It's a bit of a no-brainer, really, isn't it? But it's a great sort of company to work for in terms of helping clients and get through tax time and not have it be such a crunch, and actually supporting a whole lot of cool organisations at the same time.
What is tax pooling?
It's a great question, Rick, and one that a lot of people don't understand. It can be quite a scary word and term, but it is really, really simple at the end of the day. Effectively, it's a way to finance your tax and pay tax on your terms when you want to pay it and when that suits your business. And in the simplest of terms, we sit between your business and the IRD, and you can pay in little bits, you can buy tax back, whatever suits you as a business. It's all about being flexible to you, and we just ensure that the tax goes to the IRD at the correct dates.
So Harry, a question that even our accountants have, but I'm sure a lot of small business owners have as well, is around how can you, if you're new to business, start off by using tax pooling to the best advantage?
Yep, and there's a few ways to skin the cat here. So if you really want to be on top of your tax and you're a compliant taxpayer, right, I want to put that away for a rainy day, you can deposit into the tax pool, and that means your tax is locked up in the pool. You can accumulate some interest when you want to move it forward, and use that for your tax, especially in your first year business where you do get stung in that second year where you've got your terminal and then your provisional going into that. So you can get ahead of the game and put funds aside. The other side of the coin is if you're growing and you want to keep all that cash in the business and use it to grow, you can actually kick the can down the road, and that's the two sides of tax pooling. So we can finance that tax or our product flexi-tax, which effectively is like a floating home loan. So we can kick the tax down the road and we'll sort it out later. Let's keep all that money in the business to grow. Or we can look to finance it and pay the interest up front leading into a provisional date, and that's when you can really access the sharp rates, and at the moment we're looking high fours for that.
Yeah, wow. So if you've got cash working in your business that's buying assets or doing whatever, something productive, not just creating a bigger future problem, but the cost of those funds are high fours.
Yep, yeah, absolutely. And the opportunity cost is you pay the IRD your money and it's gone, and then you go to the bank and you've got to get your overdraft or get some lending that way, and you're paying a much higher rate.
Yeah, and a lot more hassle for that usually as well.
Absolutely, yeah. There's a lot more reports that you guys will have to prepare for your clients.
So Harry, with this, is there anything that could be considered a downside of people using tax pooling?
Yeah, potentially, if you've got clients that aren't on top of their money and they're just using it as a form to, I'm going to kick that can down the road, and then they get to there is a hard limit for tax pooling, and it's 75 days after your terminal tax date. So once that date passes, you can't use tax pooling. You've got to deal with the IRD and the penalties and higher interest that they charge. So if you're leaving it right to the end and you're left with a big lump sum, that's not great management. There are great ways to use us to avoid that. You can pay in instalments and chip away at it, so you don't get left with this massive surprise at the end and then can't pay it, and then you're to deal with the IRD and the late payment penalties and higher interest that you get with the IRD.
Right. Yeah. So this doesn't. It's not a get out of reality opportunity. You've still got the taxes and the obligations, but if you manage this efficiently and effectively, you've got far lower cost of funds. You can just maximise that.
Absolutely, and our interest rate's lower than the IRD's use of money interest rate, and then you don't get pinged with the late payment penalties because obviously the tax is going in at the right date.
One concern for clients could be if they sign up for this and they start doing the tax pooling, does that mean that they're committed to it?
Absolutely not. It's the great thing is we're not lending. There's funds that are sitting in the tax pool and they are there. And once you pay us, then the funds will be transferred to your IRD account. So there's actually no obligation there. If you enter an arrangement and say, okay, I think I need $10,000, and you get to the end of it and you go, oh, actually, I only needed 5, and actually I'll just sort that out myself. That's fine. There's no obligation there because the funds are still sitting there. We'll find someone else to utilise those. So it's a pretty risk-free option in that regard.
A follow-on question to it is, I know a lot of people think as well, and I certainly have conditioned a lot of our clients over the years to do this, that, when you pay your tax, you pay the IRD, like you don't pay your accountant and you don't do this. But obviously you guys are connected through this and regulated. What are some of the benefits that someone's got if they're paying you rather than the IRD? One I'd thought of was around the fact that actually if they overpay, they can get it back, can't they?
Yep. And it's around that flexibility and ease to deal with. I know there can be some large delays, having worked in accounting, with dealing with the IRD. If you overpay provisional tax instalments, you've got to wait till you file your return, get that processed, and I'm sure your clients deal with it and they're axing you and you're axing the IRD, whereas we can turn it around in a couple of days. So if you were to pay your instalments and deposit through us, and you get to near the end of the year and go, actually, I've overdone it, I need that back. That's really, really easy. And the likes of, if you set up a purchase instalment and you're okay, I'm going to pay this much, and then you get further down the track and go, actually, that was too much. It's really, really easy fix.
And this does happen, doesn't it, for a number of businesses? And we've all lived through things like this over the last few years where things are ticking along really well, and then all of a sudden you've got to close the doors of your business, fire, flood, illness, whatever it might be. So you've got the opportunity there, haven't you, where you can just manage the tax. You're not stuck in the regime of those 3 big provisional payments.
Yep, and that's the benefit to what we call depositing. So that's when your clients would pay directly into the tax pool, and then they've got access to those funds. So the likes of 28th of August, and I'm sure you've got a few construction clients and they might shut down over Christmas, and they could get to the end of November and be expecting an invoice to get paid to them, and next thing you know, someone doesn't pay them. They're looking down the barrel of a shut over period over Christmas, all the expenses that come with that, and they've got this money parked up. If they were to pay the IRD, it's gone. They're not seeing that again. But you can draw down on those funds as a short-term like cash flow loan, get that back, repay it, and you still get your tax back at the date. So there's all those flexibilities that come with paying into the pool.
Yeah, and the IRD is not renowned for its flexibility.
No, they're not.
So a question that we've had was, can we use our tax pooling for any other type of tax, or is it just purely provisional tax?
So with tax pooling, there's 2 sides of the coin. You can put your money in, and when you put it in on time, there's less restrictions, so you can use that for the surplus amounts for other tax types. And then the other side of the coin is when you're buying tax and purchasing it back. So there's restrictions that apply on that to only income tax, unless it's a reassessment. So which we see a lot of nowadays. IRD are really ramping up their compliance activity and audit activity. When you get a reassessment, it opens up all tax types, and you can go back as far as you need.
Could you give me an example of how, say, a more established business or even a group of businesses could actually use tax pooling to their advantage?
Yep. If we talk about a group, really effective, you can have a tax pooling group. So you only have to make one payment, and then we can manage it. And then when it comes time to file and you know what tax you need to pay, we can make the transfers within our tax pool, rather than if you're paying the IRD, you make 10 different payments to different taxpayers, which can be a real pain come provisional tax time. So that's a big advantage. And then the other one, if you're an established business, you could still be quite seasonal. So if you've got a really busy summer period and your downtime is in the winter and you're coming into 28th of August, you can use tax pooling in that way and go, well, I've actually got no money coming out of winter. I know I'll have money in March after my busy summer rush. I'm going to deal with the tax then because I know I'll have the money. So you can use tax pooling in that way to go, okay, I've got no cash here, but I know I'm established, I know what my trends are, I know I'm going to have the money, let's deal with it then, and that's how you can utilise tax pooling.
Perfect. And so you're holding on to the cash in your business, knowing that it's going to cost you high fours to ride that out.
Yep.
Yeah. So Harry, is tax pooling best for just seasonal businesses, or are there other industries or business types that you find this is really beneficial for?
I think it's beneficial for any business, and if we talk a bit to the seasonal businesses, if you've got your high peak in summer, think hospo, if you've got a real big summer rush, you might be in a tourist town, yep, sweet, we're going to get slammed over summer and make all our money, and then you come out of winter and you might have a wee shutdown, you got no business, you got no money, and depending when your instalments lie, you actually might need to keep that money in the business. So sweet, I know I'm going to have my money here, I'm going to pay for it then. In other businesses, you can use it other ways. You know, you might have quite a stable cash flow, but equally you don't really want to be paying these big hits at 3 times throughout the year. So you could go, actually, I know every month I will have this much available for tax, so I'm going to either deposit that into the tax pool or pay off an instalment with that much, so I don't get hit with these big lumps throughout the year. You can keep it nice and steady.
Great. Harry, we work with a lot of small businesses and they're operating an overdraft and potentially some of the debt, maybe even credit cards, right? So if their debt is costing them 15%, is there something that they could sensibly do with tax pooling that benefits them?
Absolutely. And if clients have got tax savings account and they have the money to pay their provisional tax, they look to finance the tax with us, and that's when you can access those really attractive rates, high fours, low fives. And that's a real cost of fund advantage without sounding too technical. If you're paying 15% in an overdraft versus you could pay 5% and use those funds, pay that down on your overdraft, and then we'll deal with that tax in 12 months, or we might deal with it in 12 monthly instalments for the next 12 months. And you can keep on top of it that way rather than having to go, okay, I'm going to pay all this tax and then I'm going to have to keep running the business out of the overdraft. So you can have a real, there can be quite a disparity in the interest rates, so you can have quite a saving.
Yeah. So quite a sensible way of doing it, like being intentional, but your debt's costing you a third of the rate.
Yeah, and I think tax pooling has got to a point now where tax is a financing decision.
Yeah,
it's not an obligation that you pay 3 times a year. It's a financing decision, and as you say, if I'm paying 15% on that, it makes complete sense to finance the tax at 5-ish% and whack that on the 15, and that's just good business.
Clear some debt.
Yep.
Harry, when we've got businesses where they've had the best intentions, right, and they've paid their provisional tax as expected, perhaps as the IRD had projected, but they've had a bumper year, made more money, didn't know it, how can they work with you to lessen the pain of that?
Yeah, and very, very common, and it's our bread and butter, right? So if you pass your third provisional instalment, you've been a good taxpayer, you've paid everything, and you're out of safe harbour, so in layman's terms, the IRD is going to charge you interest from that third provisional date, which can be a real killer because that's a month and a bit after the end of your financial year. Yeah. So unless you're really, really quick, you're going to pass that and face some pretty high interest rates. So tax pooling, all you do is go, okay, what's the difference? What do I need to buy? Okay, yep, I'm going to tax pool that, and you've got until 75 days after the terminal tax date to purchase that. So putting that in current terms, so we've just had the 24-25 financial year, so this is sort of the time everyone will be filing that. If you're out of that safe harbour, you need to have paid for your tax on the 7th of May 2025. So we're sitting here in December, Rick, and that's a long time ago, and that's gone to us
6
now.
months of high interest rates plus.
And we can sit here and a client comes to you and says, okay, this is the situation, or you go to your client. They've still got until the 19th of June 2026 to be able to settle that 7th of May tax. So you've got a whole lot of time, and also the massive savings on the IRD interest rate now is 9.89%.
Yeah.
So you can get a pretty good interest rate saving when you're looking at 7.5%, 8%. It's an attractive rate.
Yeah, perfect. And that's what you referred to as your time machine, eh?
Yep.
You're pretty much going back in time and saying, we paid that.
Yep.
And then you just defer it out at 5-ish%.
Yep. And you're a compliant taxpayer, which can be really, really useful because the IRD love dealing with compliant taxpayers.
Yeah.
They aren't so lenient if you're not compliant. So a really good advantage to doing that.
Harry, we've spoken about a number of scenarios here where we're perhaps needing to buy tax. What if you've been overpaying your tax? Can you sell it?
Absolutely. So at the very least, you'll earn some interest on it. So let's say, and again, you've paid your tax on the 28th of August and you pay 15. Okay, and you get to the end of the year and you file everything and you go, actually, I needed 10. I've got 5,000 left over. Okay, what am I going to do? So we can transfer that tax and we'll move it all the way forward to today's date and you'll earn the IRD credit use of money interest, which is 3.27% as we sit here today. So that's a good return. And equally, what you can do is you go, actually, no, I'm going to sell that. And you instruct us, go find someone who wants that tax, and you can get a little bit of a premium on that 3.27. So you can actually make your tax work for you in that respect. The IRD aren't going to pay that credit use of money interest to you. So it's a good advantage to using the tax pool.
Great. Like one of the scenarios we've spoken about is, especially with early businesses, you get paying your tax early because it is coming. The year one is not tax free. It's just calculated later. And there's really very little disadvantage if you're putting it in there. If you're putting too much in, you'll make some money on it or you can get it out. If you're not putting quite enough in, still it's a much smaller hurdle at the end of it, isn't it?
Yep, exactly. You don't get hit by that massive surprise.
Yeah.
At the end, at least you've made a dent in it, and it's nice and secure. It's not like you're in your tax savings account, in your banking app where it's all too easy to go, I need to pay that invoice. Let's just grab that and throw it there. It's just that extra layer of protection to when you do get to tax time, you go, no, I'm sorted. I've locked that away, and actually I've got some benefit from it, from earning interest.
Yeah, excellent. And that is one thing that we see, isn't it? It's when it's so easy. The money is literally, I can even pay the bill or pay the whatever out of my tax savings account. This just puts a couple of extra checks and balances in it. But equally, not as tough as the IRD, where if it's gone there early, it's locked away.
Yeah, exactly.
Now, a lot of people will probably know that, with Sidekick, we have a great proportion of our clients are rural-based agri. I will admit that it's no surprise the pommy guy in a T-shirt doesn't know much about Kiwi farming, right? But our experts that work with the rural sector, what are some of the real key benefits if you're on farm? How do we use tax pooling?
Yeah, and there's a whole range of them, right? So you think your P1, your P2 for your farmers, and especially currently, we've got heaps of cash. Okay, well, let's deposit. Let's get deposits in for P1 P1 and P2. And when you get to P3, if you've still got the cash, let's deal with that then. Or we can actually finance that. And let's deal with that later when we've maybe got a bit more cash in the business. Equally, we talk about the price of milk and maybe it's the forecasts aren't looking as good as it has been in the past couple of years. So you look there and you go, okay, my standard uplift or what the IRD expect me to pay is quite high. Yeah. But I know in reality I'm not earning as much money, so why would I pay the IRD more?
Yeah.
So really effective way to do that is you just deposit the lesser amount or what you think is best or your Sidekick accountant thinks is the best number, and you deposit that into the tax pool. And what that does is it ticks a button or ticks a box at IRD, and they don't steal the refunds. So think you've got a big GST refund coming that you're going, boom, that's going to be really, really helpful. And the IRD go, you've only paid 80 of your 100. We're going to take the 20 and apply it to your unpaid provisional tax. Whereas if you deposit into the pool, okay, I'm going to deposit 80 because I don't think I need to pay 100, and your GST refund will be protected and that'll come back to you. So
still safe because you look like you're a good member of society paying your taxes on time.
And the IRD, we just tell the IRD, no, that taxpayer is paying through the tax pool. And the ID, we're authorised by the ID to do this, and they go, perfect, that suits us. They're going to use tax pooling, so they don't know the amount, but it's just another way to go. Yep, no, that stops me from overpaying, especially if you're at P1. You overpay $20,000 there, you're not getting that back for quite a while. Yeah. So it's a great way to utilise that.
Yeah. And that cash flow in the farm, if you've got that good, accurate reporting, and you know that the payout isn't as good as you're expecting it to be, it's a stressful time. And then, to have your GST return taken off you at the same point.
Yep.
Salt in the wound.
Yes.
So, great. Yep. Perfect. So just being on top of it and using it intentionally, pay the right amount that the IRD doesn't know because you've not done your final accounts, whereas we do know.
Yep.
Yeah. So what are you seeing now with farmers? Milk price is really good. There's cash around. What are you seeing in this space at the moment?
Yep. A few different things, but the big one, they've got all this cash, and okay, great, that's looking good. But equally, the last few years might have been a bit leaner, and there's a few things that might have been, left aside. We'll deal with that later. I don't think many have been on a family holiday for a few years, and that tractor's looking a bit rough, or there's some fencing that needs improving, and it just has sort of gone to the wayside. So how can you use tax pooling for that? And I would say finance the cash you've got now and use it now in your business, rather than I'm going to pay my tax. Okay, and then I'll wait a couple of months and then I'll do those jobs, or I'll wait another 6 months. If you can pay the finance instalment, because we've got the cash, the farmers have got the cash. Sweet, pay the finance fee. It'll be high fours, low fives, and 6 months down the track. Yep, cool. I'm going to settle it then, and I'll pay my tax there, and I'll use the money that I've got on the things that I need to use it for, not tax, and that's a really good way to actually utilise. Yep, I've got the money now. Let me use it in my business, because these things have been weighing on my mind for a long time. And tax is one thing, but actually you can use tax pooling and let's kick that down the road. And I know I'll be fine in 6 months because all the jobs will be done.
Yeah.
So let's deal with it then.
So you can make the improvements that you've been desperately wanting to do, and you can still sleep at night, because worst case scenario, it's costing you 5%, and
in 6 months' time, you pay that, and then your tax comes into the ID on time. So, as we say, a lot of time travel. But, it's a great way to do it. And if we get to those 6 months down the track, and something else has come up, I just need another 2 months. Really, really easy, and it's just a roll fee is what we call it. So effectively, it's just another 2 months of interest at that really attractive finance interest rate. So really flexible in that regard. It's not like you have to pay in 6 months. Once we get there, you can roll it over. Obviously, that 75-day limit still kicks in at the end, but if we're talking 28 November, just been, and we go 6 months, you've still got quite a bit of time, June, through to 27 to settle that.
We obviously work with a huge amount of agri-connected businesses. What would those guys be doing? Is tax pooling still working well for them?
Yeah, absolutely, and it depends, how they run their business. Do they want to be paying tax in these big lumps? Do they just want to spread it out, or do they want to pay all their tax in 6 months of the year when they're making all money, and then actually I'm sorted for the 6 months of the year that I'm not? So you can, how many ways can you skin a cat? There's a few ways that you can utilise it. Whether you deposit, whether you set up a finance. You can set up a finance instalment where you get a monthly invoice and you just pay it right. On the 20th of every month, I know I need to pay that bill, and that's just the bill that I need to pay, and that goes towards paying your tax. So there's a few great ways to do it.
I'm intrigued by that one that you said, if they've made all of their money in the first 6 months of the year and then it's going to be lean afterwards, chuck in their tax that they expect to pay for the year early on.
Yep.
I presume then they earn interest on that.
Yeah, so if you've got your tax that you need, yep, sweet. But if you've got this tax that's sitting, here, and you need to move it there, you'll earn interest on that tax. So another good way to make your tax work for you.
Yeah, great, and not have the stress when the bank account's looking empty that you might still have some tax bills.
Yeah,
great.